Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're an active real estate investor, passive investor, maybe you're somebody that's working in the multifamily industry, well, fortunately, you're in the right spots every single week. On the Gray Report, we're talking about the latest research, news, reports, and insights related to the multifamily industry, real estate, and the macro economy. This week, we've got a special episode. Griffin Haddad is joining me once again. He's from the investor relations team here at Great Capital. He hosted last week's episode, so if you caught that with Griffin, Blake, Katrina, and Joe, awesome episode. You want to go check that out. But Griffin's coming back once again to talk about some articles and then doing a little bit of an FAQ. We haven't done an episode where we've just talked about some of the basics of multifamily investing, a little bit about Great Capital, but more about kind of real estate investing, multifamily investing. Hopefully it's some of the questions that maybe you're asking right now, or maybe these are questions you've had in the past. Maybe there's questions that you just like to hear them answered from us. Well, whichever the case, stick around for the whole episode. You're not going to want to miss it. Make sure you've subscribed to the Great Capital YouTube channel so you keep getting these episodes. Let's do it. Welcome back to the Gray Report. Griffin Haddad from the investor relations team here at Great Capital joins us once again. You hosted last week, so if we've got folks that listen, watch the Gray Report every single week, they're getting to know you, Griffin, just a little bit more week by week. Thanks for doing that. It was an awesome episode.
You're welcome. Yeah, it was fun to kind of be the guide to the conversation. This seat a few weeks ago, first time on the Gray Report, was feeling a little hot. Now it's maybe cooling off as I've become a little bit more comfortable in this seat and that seat behind the camera and beneath the lights.
Well, there were 4 people in the room, so it probably got a little hot. This is a small enclosed space. But so it was you, it was Blake Peroni, who's also on our investor relations team at Gray Capital, then Katrina Green, who's our SVP of property management at Gray Residential. She kind of runs the ship at Gray Residential, or property management. The company here at Great Capital, it's owned by Great Capital, and then Joe Powell, who's our VP of facilities, and he's kind of the other part of Katrina. We've got on the operations, the admin side, the office side, but then have to have a team of really skilled individuals who are keeping these physical assets in good condition and providing really good service to our residents, and he leads up those teams as well. It was a great conversation because it was like the investment side and the ops side coming together, and you guys were kind of both asking questions, back and forth. Mostly it was you and Blake asking questions to Katrina and Joe, but it kind of went both ways, and both sides of the table, if I can use that term, or both sides of the house, however you want to call it, sometimes don't always speak the same language. The incentives are different, the KPIs are different, what we're tracking. Like if you talk to, occupancy, is probably universal, but like if you like cash on cash, IRR, all of that stuff, you start, talking using that type of that jargon on site, all of a sudden eyes get glazed over and it's like, what are you talking about? We're talking about, loss to lease. We're talking about make readies. It's just a different language, but it's all kind of the same stuff. And it's really important whether you're talking very high level, I'm investing in, United States real estate, and I'm going to get into Midwestern or Sun Belt A-class, B-class, workforce housing, whatever your kind of general asset class description, to how do we actually get individuals to sign a lease, to move into this apartment? How do we get the apartment ready? How do we take care of it? How do we take care of them? And the two groups don't always speak to each other as much as one might think. It can be kind of sequestered.
You mentioned the two different languages. Even if and when they do speak to each other, which probably fairly often, there may be some miscommunication or objects or items that are lost in translation because they are speaking different languages in two very separate kind of worlds or operation of worlds, but they do combine to produce what is Gray Capital in our investment platform in the multifamily asset class. So it was an awesome conversation to have both Joe and Katrina, in the room. Their offices are located, just right next to ours. And so we do
Yeah.
get to have those conversations, but both of those individuals and both of those professionals, can be fully authentic and off the cuff, and kind of wear their emotions on their sleeve. So we've had great conversations like that in the office, but it's great for the folks that are on the other side of the camera and listening or watching our podcast to be able to get to see both Joe and Katrina in that light, but also get to listen to their experience over the past 20 to 30 years in the industry. It was fun to be able to ask them questions, kind of let them take each question on their own direction and expound on their experience. Certainly was more of an impromptu conversation, long form dialogue, as opposed to jumping into some of the research articles that we've really based the Gray Report podcast off of. And so I think it was a nice change of pace, and hopefully the listeners would agree.
Yeah, I think so too. And by the way, we're always looking for feedback here on the Gray Report. You may have noticed, we've been experimenting with a couple different formats over the last couple of weeks. We've had different hosts on, different types of guests, some different topics. We're still covering, research reports, data, articles. We've got 3 great topics we're going to talk about today. One is, nearly half of states right now have slipped into a recession. Some are expanding, some are treading water, but half are in a state of recession technically. We also are going to talk a little bit about gold. It has had an incredible run up the last couple of months. It's having a really bad day today, but just that relation of real assets and why people investors are allocating, not just investors, central banks, everyone is allocating to real assets like gold, and how that relates to multifamily and real estate. But then there was a Wall Street Journal article that our COO sent over to us this afternoon. It says that the titled "Renters Are Conning Their Way into Luxury Apartments," and it's something that we have just lived through before. It's nothing new to us, but it's something that I don't think too many people realize how big of an issue it is. And it's not just landlords are missing out on a couple extra bucks and people are getting a deal. It impacts the renters, the communities in a really negative way. There's a lot of fraud. It's really easy to do. Technology has made it way too easy. So we're going to talk all about that. And then on the second portion of the episode, we're going to talk a little bit just real estate investing basics, multifamily investing basics, some FAQs. Griffin's going to kind of lead the charge on that. But that being said, let's just jump right into it. This piece was originally, I think, put out by Moody's, but Globe Street did a nice write-up recently. Economic divide deepens as nearly half of states slip into recession. And we've got an image right here that kind of highlights which states are a recession or a high risk for a recession, as they would put it, which states are in expansion, which is a good thing, and which states are treading water. I've seen this image distributed across LinkedIn multiple times. I think it's been, I wouldn't even say controversial, but I think it is a great physical representation of what we talk about in the report a lot, in that it's hard to talk about the economy just saying the United States economy. How's the U.S. doing? Whether we're talking about real estate or we're talking about just how everybody's doing. Are we in a recession? Because it seems like we're in unusual times. And I think we've talked about how we probably don't have the right words, all of the right descriptors to describe what we're in right now. But what this map is showing, what this Moody's report is saying, is that some states actually are experiencing a recession. Some states are doing pretty well, and that might explain some of the, I guess, uneasy feelings and the uncertainty and an inability to find firm footing. What did you think when you saw this map, Griffin, when you first saw this piece?
Yeah, first and foremost, it's great to see Indiana and green here experiencing what is expansion and just being local. We're seeing the growth here in Indianapolis, the north side, the south side, up in the northwest portion of the state, in Goshen and Elkhart, and more in that Chicago, southern portion of Chicago. But
yeah,
there is a lot of red here in areas that I would otherwise maybe not expect there to be red. The Montanas, the Wyomings, the South Dakotas.
Yeah, I thought. I thought South Dakota. I guess North Dakota's got a lot of the, the oil industry. I thought South Dakota also was doing decently well and had a decent boom. But maybe that's old news.
Correct. And then just California being treading water. A lot of the podcasts or articles that I'm reading is just the economy in California seemingly is always a negative headline. There doesn't seem to be much positive coming out of there in regards to growth. People are moving away. Maybe jobs are moving more virtually and working from home. So folks are paying less property taxes and moving elsewhere, or having to maybe not deal with some of the challenges that persist in California. The other thing that just kind of caught my eye and would be interesting to take a look at in regards to our most recent capital raise would be, let's put all of our investors into their state buckets, and how many of these folks that are actively allocating into the real estate asset classes are coming from red, yellow, or green states.
Yeah, I didn't even think about that. Yeah. Just as you're mentioning that, it's definitely, I would say it's a mix. Now, to be honest, a lot of the recession high risk states, I don't think we have as many investors from. There's a lot of states are in still expansion phase, like Florida, Texas, Pennsylvania, Arizona, Utah, Oklahoma. It is interesting, the recession high risk states. It's almost like the entire. It's all the the northeastern seaboard, besides New York. But Maine, New Hampshire, Connecticut, Maryland, Virginia, all in recession or at high risk. North Carolina and South Carolina doing all right. Georgia kind of surprised me as well, that it is technically, according to Moody's, in recession or high risk to be in a recession. But some of the states that have experienced some, a lot of the positive, population growth, a lot of the reasons why so much multifamily supply has been delivered in states like Texas and Florida, it's because of the positive economic momentum, and that is playing out as we're seeing in this map. Oklahoma doing pretty well, expansion. Arizona, not too surprising there. Any other outliers? Virginia being in recession high risk,
Right.
That was surprised me. I thought Virginia has had a decent amount of growth.
It'd also be fun to match this map up with just overall population growth would be of interest to take a look at. Looking just specifically at the markets that Gray Capital is operating in. Indiana, obviously in green, we mentioned that earlier, but Michigan and Ohio are two states that we are we have on our board of target markets. Those being yellow, treading water. We've seen a lot of articles in regards to Columbus, Ohio. Continuing some. I would say great momentum in regards to growth, but the entire state of Ohio, is not going to be propped up by just Columbus.
Yeah, exactly.
So I wonder what that says for, yourself and Jay as we continue to, have acquisition targets in mind in the state of Ohio and Michigan. How does that make you feel seeing both those states, in the category of treading water?
Yeah, well, it's interesting that you brought up the population growth, because there were some recent, I think, population growth numbers are released by the census. How accurate it is, we'll see. But taking it for what it is, there actually is a correlation. I can see if I can find the piece, but Indiana has basically like a 1% annual population growth, which I was actually surprised, because Indiana, similar to Ohio, like Indianapolis is growing, especially around the suburbs of Indianapolis, and there's growth in Fort Wayne, as you said, near the Chicagoland area, and then there's a lot of other markets that are kind of plus or minus, relatively stagnant, relatively flat, maybe like a little bit of growth. They're not shrinking, but they're not growing by a whole lot. But in the Midwest, the Rust Belt, the Corn Belt, a lot of other more rural states that have traditionally kind of rural agricultural populations, economies, a lot of those more rural communities have been losing population over the last many decades. It's you don't need as many people to work on the farm. Those populations are like, hey, I don't want to work on the farm anymore. I want to go get a degree. I want to go work in a city, live in a city. And so you've seen those more rural communities see population declines, and some of the regional cities take advantage of that and be the recipients. So whether that's a Fort Wayne, or that's in Indianapolis, or a Columbus, Ohio, those markets have seen really strong or moderate population growth. What's interesting about Indiana is that the whole state is growing by 1%. And it's not just, Indianapolis has definitely accelerated a little bit, but it's also, that Chicagoland migration as well, I think, is playing an impact. But it's interesting. And for Ohio, Cleveland has been on decline for some time. Columbus is growing. Cincinnati is flat. It's growing in the suburbs. But not enough to kind of get it out of this kind of treading water territory, whether it's an economic expansion or population growth. What I just keep thinking is that it's like I keep coming back to the fact, we're born and raised in Indiana. We obviously do business in Indiana, and I've told this story before, but at first Indiana didn't seem like the worst place to invest, but it didn't seem like the best. It was a state that you could find cash flowing deals, and so there wasn't really a reason to. I wasn't forced to go to the Sun Belt to look for deals. Where if you're an investor in California or you're an investor in New York, one, you can't afford any of the properties; they're too expensive. You're getting started, you're buying a duplex or something like that. Like, man, these duplexes are like $2 million. Like, not going to start there. Where in Indiana, you could buy. I mean, the first house that I flipped, we bought for less than 100 grand.
Right.
Those are things that you can't really find those today, but those are opportunities and options. But so it was a state where you get good cash flow, and it was how I had just described Ohio. Like, it wasn't growing by leaps and bounds, but it wasn't shrinking. We weren't contracting. A little bit of growth, it's mostly you're buying for cash flow. But the way it's turned out is I don't know, Indiana's in this great sweet spot of where there's still good cash flow opportunities, but now there's all this like growth that's happening, all this acceleration. And like if I had to give just an example is Thorntown, Indiana, which is this small town along 65 between Indianapolis and Lafayette on your way up all the way up to Chicago. And it was never a boom town, but it had a much larger population in the 50s, 60s, and 70s because it had an industry of it was a big they had a big switchboard operator, like phone lines, big like switchboard operation, like patch cables, having like the cables moving over. You're gonna talk to somebody. I mean, they had a whole like streetcar, like a electric streetcar down the middle of like Main Street. They had light rail line. All that got ripped out a long time ago. But it has been in declining population for many, many, many decades. I think maybe it peaked at maybe 10,000 people, and I think there was 3,000 people living there a couple of years ago. All of a sudden, all this growth that's coming up through I-65, going up, the path of progress up to Lafayette, up to Chicago. Big expansion of Eli Lilly is doing a major facility, not too far away in Lebanon, which is this larger city, the county seat just south of Thorntown. All of a sudden, they're building new subdivisions in Thorntown, Indiana.
Right.
And like Thorntown's going to grow.
Property values in Thorntown, if you looked, I'm going to use 5 years.
Yeah, and it's appropriate, 5 years.
Kind of what you were mentioning with that first house that you flipped.
Less.
Very, very low value for probably full knockdown homes. These days, if you want to go and you want to buy half an acre in Thorntown with a 2 or 3 bedroom house, it's like buying a house in Westfield, buying a house in Carmel.
It's getting there. It's getting close. I don't know if it's there all the way yet. I still think there's some deals in Thorntown relative to
you can
Carmel,
probably
Indiana.
go in there and get some sweat equity that.
But it's on a completely different trajectory.
Correct.
And it's caught folks in parts of Indiana, I think, off guard a little bit of like, wow, there's all this growth that's happening. Now that's a specific story about kind of Boone County, kind of that which is I guess the county which is immediately northwest of Indianapolis.
Right.
But it keeps surprising me, and so we find ourselves in this environment of look around like we're actually in a really good place to invest in real estate and multifamily. One, because the prices, what you can buy the properties for, are at cap rates that allow for some cash flow, for some yield, because most investors still can't point to where Indiana is on the map.
Right.
Or they don't know the industries, they don't know the drivers. There's just too many states, there's too many other markets to focus on. And so it flies under the radar of, Indiana nowhere, Naptown, nothing's kind of going on. It's just a flyover state. While it's actually experiencing a good amount of growth, and it's amongst some of the states that are in expansion phase. So I keep being surprised. People are like, how did you narrow down? How did you know? Like, how did you narrow down, to invest in Indiana? that part's all luck.
Right.
Just
Yeah.
happened to be born here, happened to decide to stay here, and happened to say, let's keep investing here. I looked at investing in the Sun Belt because every book you would read, every guru would say, all the growth, follow the population growth. So you need to invest in Georgia. I'm glad we didn't do that. Invest in, Alabama, Florida, Texas, all these other markets, Carolinas, all great markets. But at the time, I just didn't know how to do that because I'm not from those markets. I don't know how to invest in those markets. I don't know anybody there. But I knew people in Indianapolis that had done it before. And
Yeah, and now we're kind of leading the positive headlines in regards to really multifamily, but the Midwest in general, and Indianapolis and Columbus, Ohio, are always up there as positive news stories for whether it's rent growth, population growth, you know, supply constraints. We're leading.
Yeah, I mean, if we're going to be building more things in the United States, if we're going to be, manufacturing again in America, it's going to typically be in the places that have the workforces that understand manufacturing, that are used to it, and that infrastructure is somewhat in place. Has the land, has the energy capacity, the water capacity, again, where I said the workforce, but also relatively lower wages compared to many other markets. And it's affordable. That's why people come. All right. Moving on, so we could talk about the Midwest all day. My gosh, did you see this? Well, let's talk about renters. Let's talk about renters first. Not news to us. We have dealt with this. I'm not saying we've solved it, but we have had to put a lot of effort into nip it in the bud. And that is fraud in multifamily renters. New piece from Wall Street Journal. Renters are conning their way into luxury apartments. And this piece is about Atlanta, which I have heard is kind of the epicenter for fraud. A lot of folks, weren't able to evict people from apartments. It's a whole story. It was a mess down there. It was eviction moratorium, which was just a horrible thing, horrible decision. Atlanta, where up to half of rental applications contain fraudulent information, is epicenter of the national surge in these scams. And a couple anecdotal kind of TikToks of folks showing other prospective renters how to commit fraud, essentially. This showing an ad here saying, need to move but can't get approved? Purchase my apartment package. You get a CPN, 4 pay stubs, 1 bank statement, rental and employment verification, completed application of your choice, done by me, hand heart emoji. It's just so easy. And another one, when your client gets approved for an apartment with fake pay stubs, guy is looking good, living that luxury, big shot life, hooking people up, scamming apartments. But the thing is, you don't need to go to these guys. And I hate saying this, you just go to YouTube, just Google right now. As person watching the Gray Report, you're probably not scamming an apartment. You're probably thinking about how to invest in apartments and worried about scammers like this. But Google it. It's incredibly easy to generate fake W-2s and fake pay stubs. How do I know? Because we had an apartment community here in Indianapolis where we had a ton of fraud. It was way too much fraud. No one was paying rent. And it turns out everyone was committing fraud. We were using a verification system that the renters had figured out that they could change like a birth date. And it wasn't verifying that one piece of information. And so it would come back as approved. Or they could just go get completely fraudulent documents. And what happens is when the money doesn't come in, it's not like, the landlord doesn't go on their next vacation. What happens is there's not a budget to fix the apartment when it breaks. And that specific community, we are already dealing with other issues. Expenses were high. Interest rates had run on that particular deal. It was one of our few floating rate loans. It was capped. Not fortunately, it wasn't a bridge loan or anything, but it was still floating rate. And so our escrow payments had gone up significantly more than we had originally anticipated. All was fine, but it was pretty skinny. And so then on top of that, we had delinquency rates 1 month of 35 to 40%. Only 60% of people were paying, where usually we're expecting 95% of people to pay. It was not good. So this has been going. That was about about 2 years ago.
Yep.
Two,
I was going to say a year and a half, but
year and a half.
I like 2 years.
That's when we were really dealing with the peak of it. We brought in complete new systems, ramped up our verification, also brought in a whole team that works with folks on delinquency. And so we have gone through a long process to try to eliminate bad debt, to eliminate fraud. But you can't eliminate all fraud. So quickly determining which of our current residents are real residents who want to pay but may have fallen on some sort of hardship, which we understand, and we have programs to help folks out like that, or someone who is lying to us, has no intention of paying rent, and they've just completely scammed us, and they're trying to see how long they can get
How
a
long
free
can they
apartment.
exist?
So we try to first got to triage that, kick those folks out, try to keep the good apples.
Right. How does this issue compound in a state that's maybe more tenant friendly?
Oh, it just makes it even worse and worse and worse, because let's say that you find out someone has committed fraud. Well, in Indiana, it's a pretty straightforward process. We can go to a court. We can evict them, essentially, right away. Now, some judges, depending on which judge it is, could be more tenant friendly or landlord friendly. But in most of those cases, it's relatively straightforward. Especially if everything's been documented. This is what they've done. I mean, if you can actually show that they've committed fraud, it's pretty straightforward. It's when it's a gray area, or when usually the folks that have committed fraud, that they just leave, they just disappear. But if it's in a situation where you're combining that with squatting, and I think it's more of it's not like the problems themselves are going to compound inside of each other, but it's just they layer on top of each other. So you've got some folks that are committing fraud. You got some folks that should have been evicted 3 months ago, but you're waiting. A judge has given them more time and more time and more time, or you have to wait a certain amount of time before someone can be evicted. Or in states like California, where it's pretty easy to establish residency and to be able to squat somewhere for an extended period of time. So if you have that on top of people committing fraud, it's like, how do you make any money in this business?
Unknown. Yeah, that's a recipe for disaster.
Yeah, and it comes down to a little bit to the broken window theory, though, which is like in New York, where to address crime, it can't look like a place that has crime going on. Can't have broken windows, because if you have one broken window, it looks like, well, why don't I just throw another rock or break another window, and I can probably commit a little bit of crime. The reputation is really important. If people know that you can commit fraud, or if a property isn't verifying information,
Just comes flooding in.
they'll start flooding in. We brought a property, story all too well. Some of our investors do. Previous owner wasn't screening on purpose, because they were just trying to fill the thing up. When we started screening, we started denying 50% of all applicants, which is a statistic that they mentioned in this story, that they're finding are committing fraud. And it's because the last owner and property manager said, yeah, let's fill it up. We don't care. We're trying to sell this thing. We're just trying to get occupancy of it.
Yeah, somebody's going to come buy this problem from us.
Yeah. And it's a great property. We fixed it, but it was a lot to fix. And it was a reputation problem that we had to quickly address. And we kind of just in the nick of time. So now that reputation doesn't exist anymore, and people are like, oh, you can't go.
Yeah, can't go there.
You can't go slow. You can't go there and try to pull a quick one. They're going to check. But it's just something that we live through in the property management world, and this is where post-COVID apartment investing, it's not just you got to buy right, you got to execute the value add plan, but it's operations. It's like day to day. How do you make sure that your residents are the right quality of resident, someone who is actually qualified to pay? And people will loosen up some of that qualifying, the elements, to try to get more leases. Then you end up paying for it because you set someone up. Either you set someone up for failure, they're qualified for something they really can't afford. An example of that is individuals are qualified based on the rent to income. not on what they're actually going to pay for the apartment and their income. So like you're renting an apartment for $1,000 a month, you make $3,000 a month, 30% of your income. Well, you're at the peak, but technically you qualify if 30% is your ratio or your percentage. But that doesn't include utilities. It doesn't include any fees. It doesn't include anything else. And as everyone knows, there's utilities. It's a couple $100 usually.
Yep.
There's fees, and so someone's real nut. It's not $1,000. It's like $1,300. They don't qualify. They're told though that they can afford it,
Yeah.
and so they get the apartment, but they can't actually afford it, and so that puts themselves into a really bad situation. And so it's operators being short-sighted of let's fill this thing up, but not worrying about the actual rent that we're going to collect.
Right.
And once that person fails to pay over and over again, you have to move to an eviction. Evictions are so expensive. And that's why we prefer to work with residents who are good residents, good members of the community, want to pay, something happened, we want to keep you because it's expensive to fix your unit back up and to go lease it out. It's going to sit vacant for 2 months. Well, that's money that we're never going to see anyway. And we have to spend money to get it ready. Then we have to go release it. I'd rather like give you a month or 2 months to help the situation, set up a payment plan.
Correct. Yeah.
Get back on the right track, and we don't have to spend the money. It's a win-win.
And our portfolio specialist team that you guys have put together
Yeah.
has, I think, done a really tremendous job of offering residents, whether it's across our entire portfolio, folks that are in need of a solution to whether it's a temporary or long-standing issue with overall rent payments or affordability. We've kind of rolled out this package or suite of solutions that they can use to their advantage, and then obviously on the back end, Gray Residential, Gray Capital, and our limited partners are all the beneficiaries of that, but also the resident, because now they're not sitting in a prolonged state of delinquency, and they have a property manager who not only wants them to live there, but is offering to provide their own time and assistance to make certain that their home remains their home.
Yeah.
Yeah.
Yeah. We don't want people to be in a bad
Right.
spot. It's not a good thing for anybody.
No.
All right. Last kind of article piece. This is more macro economy. This is very macro. There's not as many financial reports coming out today or these days because we've got this government shutdown. So we were supposed to have CPI. It was I think it was last Wednesday. Now it's going to come out on this Friday. Maybe we'll talk about it next week. We'll see. But I want to talk about gold. Now, gold and silver had a rough day today on October 21st. I think they're down like 5%, but that's not really what's important. The big thing is how much gold has gone up in the last year. I mean, look, 5 years. Gold is over $4,000 an ounce. I mean, it peaked a couple days ago or yesterday at $4,300. Incredible. Do you know what the U.S. government thinks the price of gold? Well, not that they think. Do you know what that's denominated to, Griffin? An ounce?
No.
$35.
Wow. I got married this past June, Spencer, as you know, and we bought my wife and I bought gold wedding rings.
Smart.
And we were buying it at peak of market. It was right about $3,500.
Okay.
And I was taken aback by that number when I was talking about it with our wonderful jeweler, and looking at this today, it's unfathomable how quickly. I mean, we bought the rings in maybe May. That's a very rapid accelerant in overall value. It's pretty unbelievable.
It is. I remember when it got over $2,000 an ounce, and it was pretty wild. It seemed like. I've always been interested in gold. I wouldn't call myself like a gold bug, other than like just I'm a fan of it as like it's the longest standing store of value that the humans have had. Besides, I think it's the oldest store of value that humans have ever had, and it's been a constant. And it used to be what we based a lot of currencies on. It's like actually it's real money, and what I like about gold, it's a physical thing, and it's the same reason why I along with other people, like real estate is because it's a real physical, tangible thing. Now, real estate has even more utility than gold does. Now, gold is shiny, it's desirable, certainly it can be used in wiring, and it's a conductive metal. It's obviously it's used in jewelry and other things. Just people like it and they want more of it. So it's always in demand. We give it, it has value because we give it value. Same thing with like a dollar. It has value because we give it value, or the federal government gives it value, or the Federal Reserve gives it value. But gold has a much better or longer track record. Gold's got like 4,000 years, plus.
Right.
The dollar in its current form, Federal Reserve notes, has like less than 100 years ish, and it's got a pretty bad track record of holding its value. It's actually devalued by quite a bit.
Yes.
And so it's interesting. Not just individuals, but central banks have been piling into gold given global uncertainty, whether that's uncertainty with the future of the U.S. economy, the U.S. dollar, or just uncertainty in the world of, where are we going? Are we entering a recession? Have we been in a recession? We've talked about uncertainty so many times on this podcast. I think probably every time you've been on the last month or so, we've talked about uncertainty, whether it's consumer sentiment or similar, how it's driven down rental rates, how it's just led to a lack of mobility. People don't want to make decisions about moving to apartments because I don't know what the financial future is going to hold. And that uncertainty has driven people to buy gold and central banks. And I'm just wondering if that's for the same reasons why there still has been a bid for, other than the long-term fundamentals, but why there still has been a bid for multifamily. And the cap rates have stayed relatively low given where interest rates are. There's still transactions taking place, because I think there's similar characteristics of being a real tangible asset. But multifamily actually has utility and cash flow because it's serving a true purpose in the economy, and it's an asset that actually has cash flow, which gold does not. Curious, are you a gold bug, Griffin? What are your thoughts? You got gold. You got some gold wedding rings.
This is the only bit of gold that I own personally.
Oh man.
My wife has a couple other things, just a few, not a lot. But in conversations, growing up, learning about stocks and bonds and putting together an investment portfolio, commodities, whatever you're going to encapsulate into your own personal portfolio, it was always such an interest that you can just go and, essentially buy yourself a brick of gold. Now you have to have enough money to do that. But it's funny because if somebody were to tell you, you put your money under the mattress or whatever, it's just disintegrating. If you put your gold bar under your mattress in 2023, well, you just... you made almost $2,000.
Yeah.
Whereas if you took that $2,000 and put it on your mattress, it essentially is probably, a certain percentage of that original amount, just because it has been devalued. But I'm not ever really personally sought out the investment into gold. But after watching,
you got a little FOMO.
I would say just sophisticated minds.
I think central banks have FOMO right now.
Right. Probably. I think it's interesting just to watch people transition into gold. And I was reading an article this morning, and it was an opinion article, so it's probably not worth mentioning too much, but they were speculating as to who specifically was moving the value of gold and who was really, buying it at certain values. A lot of it were, large institutions that were maybe looking to transfer some of their position into maybe or out of equities because they've done so well and put them into gold.
Yeah.
But it was all of these, hypothetical scenarios of what's really driving the value of gold up rather than, just overall human desire for the.
Yeah, there's this concept that, there's a lot of central banks that instead of buying U.S. bonds, out of concerns for the long-term, value of those U.S. bonds because, hey, U.S. is not controlling our deficit or debt, let's buy gold instead of U.S., as U.S. treasuries still are, but maybe more so in the past, safe haven, where else can we go? Gold. But it's funny because people kind of laughed about gold for that as in that traditional role, like as recently as a couple of years ago. It was kind of like laughed off as like, yeah, these gold bugs, and you guys are you guys were conspiracy theorists, going back to the gold standard. But it's like, well, all these countries still own a lot of gold for a reason, and now they're loading up on it.
Loading
again.
up. Our map that we have, or not our map, our chart that we have showing here is just, I think it's a five-year
5
chart.
years
So
and go.
you just take a look at some of the, I don't want to use the word lack of volatility, but some of the stability of gold. I think it was, what was that, from 2020 to 2025? It might have been 2015 to 2020. It's relatively flat there at the beginning of this chart. And it's just kind of interesting to see that it can hold its value for that long of period of time. And then within the last, let's just call it 10 months, how up and to the right it has gone.
Yeah, this would appear like a little bit of a correction is fairly
coming.
due.
Yeah.
This is all time. I wish this obviously is not all time, because we could have to
Right.
go back to the beginning of
Right.
civilization. We're just about to, but right after civilization was started around a pint of beer and growing some malted barley. It's fascinating. I always also love the story that now maybe crazy Robert Kiyosaki writes about in some of his books about he learned about, who knows if the story is true or not, but he was getting into gold. He wanted to buy gold, and he was a helicopter pilot in Vietnam. I don't know if any of this story is true, by the way. Let's assume it is. But he's a helicopter pilot in Vietnam, and he's like, well, I'm going to go buy some gold because there are these gold mines in Vietnam. And he's like, well, I'll go and get a deal. And so he lands his helicopter and goes to this village where they're selling gold, and they have a radio on, and it's probably Chinese or Vietnamese, and tries to buy gold, and they're telling, yeah, we'll sell you some gold. Spot is whatever spot was that day. And he's like, well, can I get a discount? I'm in like the middle of the jungle in Vietnam. Like, what do you mean? Like, don't I get a deal? And they're like, no, the price of gold is the price of gold. Doesn't matter if you're in the jungle in Vietnam or if you're on the New York Stock Exchange or wherever you are. It's gold. That's gold's an ounce of gold. It's so universal. It's fascinating. One story I have about gold is so my parents had a business, and they had some of their like just core executive team, and we'd get together for a like Christmas party, and as a tradition, my parents would give each executive a gold coin, 1 ounce gold coin.
Awesome.
At the time, it was a couple $100.
Yeah. Now?
The folks that had been, yeah, exactly. The folks that had been there for like 10 years or so, they would be like, we've got like a decent amount of gold coins now. This is great. I think about all those folks now.
Yeah.
So that was like hundreds of dollars back then, which again, we think of it as cheap, but the value of the gold didn't change. It was still just as valuable. It's just the value of the now it costs thousands of dollars to buy the same amount of gold. And I see this, and that's where I see it similar to as apartments. As apartments can be a store of value as well, because they have utility. People always are going to need a place to live. Always are going to need shelter over their head. And the value of the dollars, is it the price of the apartments that are increasing, or is it the value of the apartments are staying relatively constant, but it's the value of the dollar is declining? And I think it's a different way to look at investing in real assets, as more of a bet against the dollar in addition to or instead of an investment into the underlying asset, into multifamily.
It's an interesting lens. I don't know if I've thought about it like that previously.
It's one of the reasons why I started really liking real estate and multifamily as kind of that macro bet against the U.S. dollar, or kind of shorting the U.S. dollar over the long term.
Yeah, that's very cool. That's also a fairly good transition into a few of the questions that I have to ask, and
Let's do it.
We've got about 10 minutes to do so. We last week got to sit down with Joe and Katrina, talk about property management, and just the general day-to-day operations, across the last 30 years. We would just be curious to talk about, investment management, and really just how you're looking at multifamily acquisitions, dispositions, and the overall investment into a multifamily property or in the asset class. You had mentioned just jumping into multifamily, choosing the multifamily asset class to not only invest your own capital into, but to go out and raise outside capital to invest in the asset class. there's retail, there's industrial, there's, you name it, of different asset classes. I just found out about truck parking the other day.
Yeah, man, I
So
like truck parking.
what about multifamily? Caught your eye initially and was kind of the catalyst for the pursuit and the exclusive pursuit of where Gray Capital and you and Alex are investing your own money.
Yeah. I mean, I'd love to say that it was as sophisticated as a white. I put together a white paper thesis on how multifamily was a long-term short against the U.S. dollar and all this macro stuff, and but that wasn't exactly it. I mean, that concept definitely played a role. I was I had some experience investing in real estate, flipping houses, but I had started another business in the kind of the craft beer industry, commodities, selling hops and brokering hops. And I was growing that business and then learning more about that industry and realizing that that industry didn't have great long term prospects. And so that's when I decided to start looking at selling that business. And as I was doing that, I was just thinking more macro about, what do I want? What industry do I want to, hitch my cart to for the long term? And I wanted to build a business. And what industry did I want to do that in? And again, I liked real estate, and so it really part of it came down to is what And I think it's why a lot of people get into multifamily is they start in residential because the barrier of entry is so low. And I don't think that's not unique at all. It's very kind of just straight down the middle of okay, well, what's the difference between an apartment and a house? It's most of them are built the same way. It's just you've got a couple more walls and a couple more entry doors and maybe on few more acres, and eventually you need some people to help maintain it and operate it. And so the transition, I'd understood rentals and single family homes, and so that the concept was really seemed to be straightforward. And I started reading every book I could get my hand on, but then I got really deep on the Bigger Pockets website, and this was like 2014, time period, 2015 time period, when it was like a thing, but it wasn't as big of a thing. This is like when like Brandon Turner was still like actually working for Bigger Pockets, like he was kind of new at Bigger Pockets, and he had written a book, and people were writing books, but like the syndication surge hadn't happened. Like the term syndicator wasn't being thrown around a lot. It was a thing. Syndications, it's not a new term by any means. People have been putting together real estate private equity deals for years, but we have to remember that it was just in 2012 is when the Jobs Act was passed that allowed for 506c exempt offerings, private placement exemptions, or crowdfunding, in which that really, I think, accelerated this whole syndication boom. That was the catalyst. This is only 2 or 3 years after that. So people were doing it, but not as many people were doing it then as today. And when I looked at an industry that we could be participating in long term, it was very scalable, something that we could understand. And I thought that we had an ability to generate really good cash flow, build wealth over the long term. So from a personal finance standpoint for me and my family, it seemed like a way to, again, coming back to Rich Dad Poor Dad, Robert Kiyosaki, he'll tell you to, build a business that buys assets. And that's exactly, very simply, what multifamily is and what Gray Capital is. Gray Capital is a business that buys assets and accumulates assets.
Right.
We're not just a business that has a product that we're selling and we're generating some cash flow. That individual apartment might be selling a service, as in the apartment itself, to rent. But Gray Capital is really accumulating assets. We also have cash flow. We're generating revenue and cash flows through the services that we provide, which are property management services or investment services. But the core concept is a business that acquires and builds assets over time for long-term financial security and financial freedom.
And just the exclusivity to the multifamily asset class, you could have without going too deep in the history books, when you were doing, let's just use Pinnacle
Yeah.
on Meridian as an example, was a condo
Yeah.
deconversion into for rent, market rent apartments. That deal specifically is one that we've talked about that maybe cast some serious doubts or
Yeah.
had some serious adversity in what you guys
Yeah.
had to battle through. You could have pivoted and said, look, this multifamily thing, probably it's not for me. I'm going to go more industrial, more retail.
Yeah.
But being able to stick with the multifamily asset class, what was it about multifamily in regards to or in comparison to some of the other real estate asset classes that, really drug you in and captivated you and allowed you to not only experience
Yeah.
Pinnacle and Meridian, but persist through that?
Well, I think the inelastic demand,
Mm-hmm.
and again, there's always a need for housing. There's the demand doesn't really change. There's always demand for housing. The supply can change. The demand changes a little bit. But if you have no money, again, it can decrease a little bit, and the capacity to buy is limited to wages. But there's always a need for housing, and that makes multifamily very recession resilient. Not resistant. Like, you still have issues with multifamily, you still go through recessions, but it's a very recession resilient asset class, especially compared to some other real estate asset classes like office, for example, or
Mm-hmm.
hospitality, some types of industrial, some types of retail. So just that resiliency. And then again, I'm just learning a lot from my parents and my father in particular on, because I'm helping him invest into apartments at the same time and looking for asset classes investment that have like really low risk, but we can still make money in,
Mm-hmm.
and which that's like what everyone's looking for, right? But
Right.
that's what we were looking for. How do we generate some cash flow that is very tax efficient that we can then multiply our capital over time, but take the least amount of risk possible? And multifamily really seemed like it was in the sweet spot. And in our experience, I can't speak for everyone because there are deals that have gone, not our deals, but there are
Mm-hmm.
deals out there, investors who have lost a lot of money over the years. But from my personal experience, the deals that I've chosen to invest in and have my family invest in, we've never lost a single penny investing in real estate. We've only made money investing in multifamily real estate. I think we're probably a little bit lucky. Probably chose some right markets. Probably got lucky with some right markets. But it's done exactly what we had set out for it to do.
Yeah. Let's
And
do.
then also just multifamily singleness of purpose. I mean, I have
Mm-hmm.
invested as an LP in some other deals, but great capital. I know what I know. We've been successful at doing this one thing. We're going to keep doing it.
Mm-hmm.
And it's easy to get distracted by shiny objects that are out here. There's a million different ways to do real estate. And I get asked every single day, hey, you want to partner on this project, this retail deal, this industrial deal? You want to sign on here, this creative? I'm like, incredible ideas, guys. I don't know anything about it.
Mm-hmm.
This is what I know.
Right.
This is what I do. I'm going to keep doing it until it doesn't work anymore. But fortunately, people are going to need a place to live for a long time.
We have just a few minutes remaining. Spencer's a busy man with a pretty booked calendar. I have one more question to ask, and you can answer it, abruptly. We had a prospective investor come in our pipeline, quite interested in one of our acquisitions more recently than not. One of his criteria was, hey, I'm going to put my kids in the car. They're college age kids. And then we're going to drive past the asset and we're going to talk about it. And then I'll get back to you and make a commitment. And he was already personally convicted. He was in the deal.
Yeah.
He committed, but he wanted to show his kids,
Yeah.
the asset and where that money was going. My assumption is that at some point in time, that interest in that project, whether it gets rolled into his kids' accounts or how he's just trying to teach them about investing in real assets, specifically multifamily. Your kids are probably, in my opinion, a little bit too young to be maybe fully getting exposed to real estate investing. What do you tell your kids that you do?
That's a really good question, because it's not that what we've done has evolved over time, but like how it's not as straightforward at like their grandfather is a doctor,
Mm-hmm.
and so it's like grandpa's a doctor. Like, it's really straightforward to say, like, it was a policeman, it's a firefighter.
Right.
Real estate. Like, what is a real estate? And but then it's even more complicated, because it's like, well, yeah, we buy apartments, we fix apartments up. I raise money from investors, and then we also do property management. So I have 3 kids, 9, just 7, and 3. So the oldest one, they come to work, relatively frequently, not like
Right.
every day, obviously, but you've seen that they'll come to the office with me, and they'll see what we do, and they have my 9-year-old has a better understanding than most people. and she knows a little bit more on like the investing side. But for the 7-year-old, we haven't really got into it with the 3-year-old just yet.
Right. I can't imagine.
But it's, we help people, find homes.
Yeah.
We provide homes to people. And a 9-year-old, we get a little bit more nuanced on. We also help people take their money and turn that into more money.
Right.
We also help people find houses or find apartments, places to live, homes. We provide a service give them an apartment for them to live to. Our kids have, come to our apartments. They've been to every single, apartment of ours, but especially the ones locally. They'll come. They'll be with Alex or be with me, and so they've seen this. They've seen these apartments. Mm-hmm. They've seen where we do. We show them, like we've fixed this up. We've painted this. We've fixed these buildings. These are the people that live there. I think it's still a little complicated to them, but at its core, so we're helping people. We're providing houses or housing to people. And then when they get a little bit older, we're also helping people take their money, invest it into the houses or apartments, to turn that into more money over time. And they do understand at a pretty young age that more money is better.
Yes. Yeah. Well, so, I would assume that's of
they like that part of
their best interest as well to kind of understand. I asked that question just. I think what you and Alex have built at Gray Capital, it's obviously a great opportunity for you guys to continue to grow, your family's wealth and, preserve that over generations. And so when this prospective investor had mentioned that he's going to run his kids by the asset to just kind of teach them, I was somewhat envious that nobody exposed me, to this asset class or, real assets in general until I kind of discovered it for myself. And so I think it's an incredibly awesome thing that your 3 kids will have exposure to the asset class at such a high level, but also just a really good educator in both you and Alex as they persist and grow up. So I know we are over our slotted time.
We're good. Thanks, Griffin. Thanks for being on. This is a great episode.
Absolutely.
Hey, everybody, make sure if you're not subscribed to the Gray Capital YouTube channel, you do that right away. Hit the bell icon to be notified, and let us know how's Griffin doing. I think you're doing a good job, Griffin. Come on a number of times, but also we've got a really good newsletter, Gray Report newsletter. Sign up at graycapitalllc.com. It's the best multifamily newsletter in the industry. You're not going to miss it if you're not signed up. But if you're listening right now, still on this YouTube show, you probably should sign up for the newsletter because you've been here this long, and we appreciate you because you are amongst the 7% that listen all the way through. Godspeed. Thank you. Catch you on the next episode of the Gray Report.